Hey everyone, and welcome to another deep dive. Today we're taking a look at Metromile.
Metromile,
They
yeah.
tried to shake up the car insurance world with this whole pay-per-mile model.
It was a pretty interesting idea, especially for, people who don't drive a ton.
Yeah, like why should you pay the same as someone who's on the road all the time?
Exactly. Metromile was all about making car insurance more fair and saving people money.
So how did they make this pay-per-mile thing actually work?
Okay, so they had this little device. It was called the Pulse,
Uh-huh.
and you plugged it into your car,
Okay.
and it tracked how much you drove.
Gotcha. So you couldn't just like fudge the numbers.
Nope, they had your actual mileage. So they would charge you a base rate
Hmm?
and then a per mile rate on top of that.
Kind of like I don't know, a cell phone plan.
Yeah, exactly. You pay for what you use.
And who were they going after with this? Who did they think would be like their ideal customer?
Low mileage drivers, for sure. People who maybe bike or take public transit most of the time.
Makes sense.
Yeah, because a lot of drivers, they figured out like 65% of them drive less than 200 miles per week.
Wow.
And those folks could be overpaying with traditional insurance.
So Metromile saw a real opportunity there.
Absolutely. They even promised drivers could save like an average of $500 a year.
That's a lot of money.
Yeah, it is.
So they have this cool technology, this unique selling proposition. You'd think they'd be set up for, massive success.
Well, not quite. I mean, remember their SPAC IPO?
Oh yeah, the SPAC. That was a whole thing.
That's where things get really, shall we say, interesting.
For those of us who don't spend all our time thinking about Wall Street, can you remind me what a SPAC is?
Sure. So a SPAC, think of it as like a fast track to going public.
Okay.
It's basically this shell company that raises a bunch of money through an IPO.
Right.
And then their whole goal is to find a private company like Metromile,
Mm-hmm.
merge with them, and bam, the private company goes public.
So it's way faster than the normal IPO process.
Exactly, a shortcut. And for Metromile, it was a wild ride.
Yeah.
They merged with this SPAC, and their stock, get this, it shot up to almost $20 a share.
$20?
Yeah.
That's huge.
Yeah, investors were loving them. They were valued at like over $2 billion.
Wow. Everyone must have thought they were going to, totally revolutionize insurance.
Yeah, there was a ton of hype. But as we all know, what goes up,
Must come down.
right. And in Metromile's case, it came crashing down. Their stock plummeted. I'm talking under $1 a share.
Ouch.
Yeah, it was a tough fall. And it wasn't just the hype wearing off.
What else was going on?
Well, the insurtech market was getting really crowded. There was a lot of competition popping up. Companies like Root Insurance, for example.
Root insurance. What were they doing?
They were also into personalized insurance. But instead of just mileage, they were tracking driving behavior.
So, how well you drive.
Yeah. Hard braking, speeding, even how smoothly you accelerate, they tracked it all.
So one company's rewarding you for driving less, and the other one's rewarding you for driving well.
Exactly. That's an interesting question to think about. Which approach sounds better to you?
It's something to ponder. And we'll be right back to keep unpacking this whole Metromile story.
So before the break, we were talking about how Metromile was facing some serious competition.
Yeah, like Root Insurance and their whole driving behavior thing. It's like, did Metromile just not quite make it?
Well, to understand that, we kind of got to look under the hood, so to speak.
Okay, I'm intrigued.
Luckily, Metromile released their annual report for 2021, before Lemonade came along.
Oh, perfect. Let's see what their financials look like. Were they raking it in or were they struggling?
So their revenue was actually pretty good. They hit over $100 million for the year.
Not bad.
Yeah, not bad at all. But then you look at their net loss and, well,
Uh-oh. This is where it gets bad, huh?
over $200 million in losses.
Whoa. That's a lot of red ink.
Yeah. And when you break down their expenses, you see a lot of it was going towards tech development, marketing, trying to get new customers.
Ah, the classic startup struggle. Spend money to make money, right?
Right. But it was really adding up for them. They were trying to convince people to switch to this whole new way of doing car insurance.
Which I imagine is not an easy sell.
It's not. Plus, they were up against some major players.
There's big insurance companies.
Exactly. Geico, State Farm, those guys, they have massive marketing budgets. Metromile had to spend a ton just to get noticed.
It's like David versus Goliath.
It really was. And to make things even trickier, you know who was actually the hardest to convince to switch?
Ooh,
Low mileage drivers.
really? But they're the ones who would benefit the most, right?
You'd think so, but they're often paying lower premiums already because they don't drive as much.
So they're not as motivated to shop around.
Exactly.
So Metromile was kind of facing this uphill battle from the get-go.
Yeah, they were. But it wasn't all doom and gloom. I mean, their balance sheet wasn't terrible.
Oh, yeah.
Yeah, they had a decent amount of cash on hand and they weren't drowning in debt.
Okay, so they weren't completely broke.
Not at all. They had some breathing room, But their main problem wasn't running out of money. It was figuring out how to make money.
How to actually turn a profit.
Exactly. Which brings us to Lemonade. What did they see in Metromile? Why buy them?
Yeah, why?
Well, Lemonade was already a big deal in InsurTech, known for their app, their use of AI, and their Give Back program.
Give back program, what's that?
So basically, they donate some of their unclaimed premiums to charities that their customers choose.
Oh, that's cool. Insurance with a conscience.
Yeah, it's a really popular feature. So Lemonade had this great brand, a strong tech platform. They were already shaking things up.
And then they saw Metromile, who had this great tech and customer base, but were struggling to make it all work.
Right. Metromile had this pay-per-mile tech that could fit in perfectly with what Lemonade was already doing.
Like a missing puzzle piece.
Exactly. Lemonade wasn't just buying a company, they were buying a vision.
And that vision was all about personalized insurance.
Exactly. And that's how Metromile's journey as an independent company came to an end.
But their story isn't over yet.
Right. We'll talk about their legacy and what we can all learn from Metromile coming up.
Okay, so we're back and ready to wrap up our deep dive into Metromile. We've talked about their big idea, their ups and downs in the stock market, and then ultimately how they ended up becoming part of Lemonade.
It's been a wild ride.
It has. So what's the takeaway here? What can we learn from all of this?
I think the biggest lesson is that having a great idea is just the start.
Yeah.
You got to have a solid plan, you got to know your market inside and out, and then be able to actually make it all happen.
Metromile definitely had a great idea. Pay-per-mile insurance, I mean, that makes sense.
It does.
But it seems like they maybe just underestimated how tough it is to make it work as a business.
That happens a lot with startups. They're so passionate and want to change the world, which is great.
Yeah.
But sometimes they need a little bit more of a practical, business-minded approach.
Right. And we
Yeah.
can't forget about the competition. I mean, the insurance world is not exactly a friendly place.
Oh, it's fierce out there. They were up against some giants with tons of money and huge brand recognition.
Exactly. So Metromile had to really fight for every single customer. And that costs money.
A lot of money. Remember those customer acquisition costs we talked about?
Yeah.
That was a big part of why they couldn't make a profit.
So was Metromile just ahead of their time? Or did they make some bad choices along the way?
It's hard to say. Maybe the market just wasn't quite ready for pay-per-mile back then. Or maybe they could have done things a little differently, focus on a different group of customers, or found a cheaper way to get new ones.
I guess sometimes timing is everything.
It really is. But here's the interesting thing. Even though Metromile is gone, their vision of personalized insurance, that's very much alive.
Because of Lemonade, right?
Yeah, Lemonade's using their tech, and other insurance companies are also getting into the whole usage-based pricing thing.
So Metromile was kind of like a shooting star. Brilliant, but gone too soon.
I like that. They blazed a trail, and even though they didn't get to the end of it, they helped make a path for everyone else.
So where does this all go from here? What does the future hold for personalized insurance?
That's a great question. And I think it's a trend that we should all be paying attention to. As technology keeps getting better and we can assess risk in more and more sophisticated ways, the possibilities are pretty exciting.
Okay, like what? Give me an example.
Imagine car insurance rates that change in real time based on how you're driving, the weather, even traffic.
Oh, that's both really cool and kind of scary at the same time.
Yeah, there's definitely a line between personalization and privacy that we have to be careful about.
True.
But the potential benefits are huge. It could mean fairer pricing, safer roads, maybe even lower premiums for good drivers.
Yeah, it would be amazing. Well, it's definitely been fascinating to dig into the story of Metromile. They may not have been around for long, but they definitely left their mark.
Yeah, they did. And their story is a reminder that innovation is a process.
It's not always a straight shot to success. There are going to be twists and turns and surprises along the way.
Exactly. Thanks for joining us for this deep dive.
And who knows what other innovations are just around the corner. Until next time, keep on diving.